Hey everyone, welcome back to Corporate Decoder, the place where we turn complicated corporate filings into something you can actually understand. Today, we're diving into ModivCare's latest 10K report. And let me tell you, this one's a bit of a roller coaster. It's like they're building a luxury condo, but the foundation might be a little shaky. We'll get into that shaky foundation in a bit. ModivCare at its core is about connecting people to care. Think of them as the behind-the-scenes folks making sure people get to their doctor's appointments, have support at home, and get monitored when they need it. The thing is, providing these services is getting more complicated. They operate in three main areas, which they call segments. First, there's non-emergency medical transportation, or NEMT, which makes sure people get to their doctor's visits. Then there's personal care services, PCS, which provides in-home aids. And finally, there's monitoring, which uses technology to keep an eye on people's health from afar. So what's ModivCare trying to do? Their big plan is to make everything more efficient and standardized, like a well-oiled machine. They want to use technology to improve things, keep costs down, and ultimately deliver better care. It's a good goal, but the path there is where things get interesting. Let's start with NEMT. They're working on a transportation network that's reliable and on time. It's about getting people the right kind of ride, whether that's a car, rideshare, or even reimbursing a family member for driving. Their PCS segment focuses on making life easier for caregivers so they can focus on patient care. They're centralizing a lot of the background tasks so that these frontline workers aren't bogged down with paperwork. And for monitoring, it's about grabbing more market share and using data to improve patient outcomes. Technology is a big part of this. They want to give members real-time updates on their rides, use better routing systems, and automate billing. The goal is fewer inbound calls, better on-time performance, and happier customers. They are trying to implement an all-in-one e-learning solution. ModivCare wants to grow, and they're looking at both organic and inorganic growth. Organic growth means getting bigger by winning new contracts and expanding in existing markets. For NEMT, it's about grabbing more of the Medicaid market. For PCS, it's about hiring more caregivers and building stronger relationships with referral sources. And for monitoring, it's about getting more health plans to cover in-home monitoring. Inorganic growth means getting bigger by buying other companies. They see opportunities to acquire smaller players in both the personal care and in-home monitoring spaces. With a fragmented personal care service, they feel they are well positioned to acquire regional providers to enter new markets and tuck in acquisitions to grow our presence in existing markets, as well as to branch out into adjacent businesses. So where is all the money going? They're focusing on operational efficiencies and technology. That means investing in platforms that streamline things, improve the client experience, and make their processes more effective. They're also keeping an eye on opportunities to return value to stockholders, like dividends or share repurchases. But it's not all smooth sailing. They're facing some big headwinds. An aging population is driving up demand, but so is pressure on governments to cut costs. There's also the shift to managed care, which can limit their market share. CMS released new regulations which will affect the business. Then there's the big one, Medicaid redetermination, which is decreasing membership at their NEMT segment. And of course, macroeconomic conditions, which means the impact of inflationary matters and changes in interest rates. It also appears that caregivers are also getting difficult to retain, as a highly fragmented manner, and with few large participants and many small ones, it might be difficult to maintain favorable competitive positioning. And on top of everything, their PCS segment must still comply with a number of reporting requirements due to payments they have received in the past. All of these new trends and regulatory measures have created some uncertainty. Here's a big one. ModivCare relies heavily on a few key customers like state Medicaid agencies and MCOs. If they lose one of those big contracts, it could really hurt their revenue and results. In 2024, for example, contracts with state Medicaid agencies and MCOs represented all revenue. Delays in getting paid or not getting paid at all are a major headache. They also have to make sure their IT systems are reliable and secure because a data breach could be a disaster. Integrating new acquisitions has also proven difficult. If their estimation of what a reporting unit is worth is incorrect, their financial results could greatly suffer. As an example, $105.3 million in write-downs had to occur due to failing to make projections at the monitoring reporting unit. They have a history of senior management and workers leaving the firm. This is not a good sign, as losing those key members will significantly hurt profitability. Regulatory compliance is a huge deal. They're subject to all kinds of healthcare laws, including anti-kickback statutes and self-referral prohibitions. Violating these laws can result in fines, penalties, and even exclusion from federal healthcare programs. The end of the COVID-19 public health emergency also creates some uncertainty, as certain waivers and regulatory measures are being wound down. A number of regulatory requirements will likely increase, and they may face operational problems that they were previously afforded grace for. Here's where that shaky foundation comes in. ModivCare has a lot of debt, and those debt agreements come with strings attached. These strings, called covenants, limit what they can do with their business and require them to meet certain financial targets. They might not be able to generate enough cash to cover all that debt. This would force them to make tough choices, like selling assets or cutting back on investments. This reliance on loans is not good, as they also need money to service those loans. Their flexibility as a company becomes limited. To add to the pressure, they've had a history of operating losses. This isn't a new problem, but it's definitely a concerning one. They've had a lot of turnover in their leadership team, which creates even more instability. It's like trying to steer a ship with a constantly changing crew. Now, here's the really concerning part. Their own financial statements say that substantial doubt exists about the company's ability to continue as a going concern. That's accountants speak for. We're not sure if they'll be able to pay their bills. They did get a bit of breathing room by getting a new loan and some covenant relief from their lenders, but it comes at a cost: higher interest rates and more restrictions. The future isn't without risk, and because the company's stock hasn't done well, the company is now potentially part of a class action lawsuit for purported violations of federal securities laws. And if they can't maintain effective internal controls, people might lose confidence in their financial reports. It's really important to stay on top of these controls and not repeat past mistakes. Finally, there are some anti-takeover provisions in place that could discourage a change of control. In other words, it might be harder for someone to come in and buy the company. All in all, ModivCare's in a tough spot. They're providing important services, but they're facing a lot of challenges. They're going to need to execute their plan flawlessly to get back on solid footing. While their NEMT segment has a strong history of profitability, the recent acquisitions of Simplera, VRI, and GMM have underperformed expectations, requiring significant non-cash goodwill impairment charges. Despite these red flags, they are taking a number of actions to improve profitability by seeking to streamline and standardize certain processes and implement best practices throughout the organization. It seems like the hope is the implemented new process improvements, as well as potential revenue stemming from newly obtained government grants, may materially improve profitability. So, what's my take? This is a company with potential, but also with a lot of risk. They need to turn things around quickly to avoid a real crisis. Thanks for watching. If you found this helpful, don't forget to like, comment, and subscribe for more deep dives into the corporate world. What do you think? Let me know in the comments below.